We'll be starting the session proper at about 7:02 p.m. Let's give some time for some of our friends to join us. Meanwhile, just relax for a while and we will start real soon. Okay, thanks everyone once again for joining us for our live webinar on trading COMEX Gold Futures. This is Phil Gunn. I am an account manager with Phillip Futures. In today's webinar, we will be discussing COMEX Gold trading on our platform, the Nova platform. Before we begin, I'd like to do a sound check. If you can hear me, just type yes into the question box. Also, during the webinar, if you have any questions, do type them out in the question box. I'll address all the questions at the end of the session. Okay, it looks like everyone can hear me clearly, so let's get started with today's webinar. Yeah, my name is Phil Gunn. I'm the speaker for this webinar, and I've been with Phillip Futures for 12 years now, since 2008. I hold a dual license in futures and stocks, and I'm a account manager to help clients trading in futures and forex, as well as shares, with understanding the product and market by providing coaching and economic information to make proper, sound trading decisions. Back in 2020, we have seen gold prices testing new highs of 2,000 and beyond per ounce. This is mainly due to the stimulus packages introduced to combat the economic downturn brought by the COVID-19. We will explore the fundamental factors that influence gold prices and whether gold prices will maintain such levels in 2021. But before that, we will first touch on understanding the mechanisms of COMEX Gold in the first half of the webinar. Throughout the webinar, you may have questions. Feel free to post them in the questions box. My facilitator will arrange them and let me know, and I'll answer them during the webinar, or if I can, at the end of the webinar at the appropriate time. This webinar itself will also be put up later on YouTube after today, so that you can revisit if you wish to do so. Okay, let's get right into it. For the disclaimer, before we start, materials provided here is for general information and does not constitute a recommendation or solicitation to trade. The topics that we're covering today are as follows. The first part of the webinar will be understanding the product. We'll be looking at the contract specifications of gold futures, therefore tick size, expiry dates, etc. Taking a look at the difference between the trading COMEX Gold Futures as compared to other gold options available. At the end of that, we will look at some scenarios of trade examples to understand the P&L calculations of executing the trades. After that, we will be discussing the fundamental factors that affect the price of gold, touching on recent events and the outlook of gold in the fundamental big picture. Besides fundamentals, I always advocate a dual approach of looking at technical analysis as well to have a good idea of ideal price levels to enter and exit. As the price levels determine how profitable the trades are going to be, technical analysis will also put in perspective what the current scenario is, whether prices are still in trend or on retracement correction mode or consolidation. Lastly, we will have a quick demonstration of our Nova platform for the charts and the trades. Okay, let's get started. What is COMEX Gold Futures? First of all, gold is viewed as a safe haven asset. COMEX Gold Futures is a contract that is traded on the US COMEX exchange. Like all exchange-traded products, it is fair and transparent. Market prices are determined by each individual participant in the market. The market participants can be the institutions or retail investors. When you trade in COMEX Gold Futures, you do not own the underlying, that is, the gold itself. It is just a pure speculation of the gold prices. As it is traded worldwide electronically, there is superior liquidity, which will translate to tight market spread and very easy exit of contracts. The market is always filled with participants. There is a trading volume of about 27 million ounces daily. As of today, it has an average 50K contracts traded every single day. The price of gold is given in ounces. So, for example, 1,900 price of gold means it is 1,900 US dollars per ounce. Let us take the analogy of buying physical gold. If you have experienced before, if you were to buy a gold bar, a 100-ounce gold bar, you would pay at 1,900 per ounce. Right now, that would cost you about 190,000 US dollars in cash. When the price rises to 1,910, you can then sell for 191,000, thus making a profit of 1,000 US dollars in this transaction. COMEX Gold Futures works the same way, except without the physical gold. You can speculate on this increase in gold price itself electronically over the internet. This is more efficient and timely as the price is updated every second. So how do you trade COMEX Gold Futures? Well, firstly, there are two contract sizes that's made available to you. The regular size is the 100-ounce contract size, and the micro contract size is the 10-ounce contract size. One micro contract lot size will require an initial margin of 1,100 US dollars to start trading. A regular contract size, which is 10 times bigger, will require 11,000 US dollars. This means you do not come out with the full value of the contract, which is the 190,000 for 100 ounces. In fact, you just come up with a ratio of it, as it is a leveraged product. In the earlier example of 100 ounces, you pay 190K US dollars, but over here for COMEX Gold Futures, the regular contract, you only come up with 11,000 US dollars to start trading in it. Hence, you can buy at a lower rate and speculate on the price and sell it at higher rates using the trading platform anytime you want. For starters, you can start trading in the micro gold contract size. The micro contract size, for example, if you want to buy 10 ounces of gold at 1,900 and sell it back at 1,900.5. That would be a profit of 5 US dollars. The spread is tight at 10 cents, and the commission is currently on promotion, but it will be changed to $1.70 USD per site per trade coming 1st of February. Round trip will be $3.40 USD, so you can actually break even with 40 cents or 4 ticks. Typically, the rate is $3 USD per trade, but the promotion rate has been extended indefinitely into 2021. For the regular contract size, commission is at 12 US dollars, so the break even will be 30 cents to break even. There is no interest charged for the positions, but the contract expires every 2 months, so you need to do a rollover every 2 months. Or you can trade the further month, but that would be a wider spread. A rollover simply means closing out the current month position and opening a new position in the new month. For example, if you are trading the February month right now, which is expiring soon, but you will wish to maintain your position. You can roll over by closing out your February month position and opening a new position simultaneously in the next month, which is April. What are the characteristics of COMEX Gold Futures? Well, it is a bidirectional market. You can initiate a buy position or a sell position first if you think the market is going down. This means you sell at a higher price and buy back later at a lower price. As mentioned before, there are two contract sizes, the 10 ounce, which is the micro contract size, and the regular one, which is 100 ounces. You can do multiple lot sizes if you wish, example, 2 micro lot size for 20 ounces. The initial margin required is $1,100 for 1 micro lot size, and 10 times that for the regular. You can fund the account in SGD or USD if you have USD funds, and start trading with the amount that you have in the account. But interest will be charged on the USD 1,100 for overnight trades if you fund in SGD. You can avoid this interest totally by converting the sync funds into US dollars or funding directly in USD. For intraday tradings, therefore trades close up before 6 a.m. Singapore time. It doesn't matter if your margin is in Sing or US dollars. Also, there's a daily settlement price at 6 a.m. Singapore time. The trading hours are continuously from Mondays 7 a.m. to Saturdays 6 a.m. When you hold positions past 6 a.m. Singapore time, it is considered as an overnight position. Your position will be marked to market based on the settlement price given by the exchange. If the market is going against you, a margin call will be triggered, and you need to top up to maintain the position. More details will be given later on the calculation of the trades. Only the even contract months are traded. So think of February, April, June, August, and so on. You can choose which months to trade in. So for shorter term positions or intraday positions, it is advisable to use the nearest month, example April, rather than June, as there's more liquidity and spread is tight to break even easily. For longer term positions, you can adopt in the June contract or in the August contract. It is also to note that there will be no interest charge if the margin is made in US dollars, or if you are just doing intraday trades, that is closing out your position before 6 a.m. Singapore time. So that covers the characteristics of the COMEX Gold Futures. Let's look at the reasons on choosing to trade on micro index futures instead on the COMEX Gold Futures. First of all, you will have good control on the risk exposure. You can select in denominations of 10 ounces contract to decide the size exposure you want for yourself. To take note that the regular and macro size are different contracts, and you cannot mutually offset with one another. That means if you open a position, maybe you have 10 lots in the micro size, you cannot match it off with one lot of the regular size. They are considered separate contracts. Next, it is a highly liquid market. So this allows the live display of market prices of gold as compared to other products such as gold ETFs, which is based on the net asset value, which is much slower. There is no interest, but you need to roll over the positions if you wish to maintain your position when the contract month expiring is approaching. There's a tight bid and offer spread at 10 cents or 1 tick, which makes it easy to break even after adding in the commission cost. So as mentioned, the promotion rate is 3.4 US dollars coming February for the micro lot size. So to break even is 4 ticks or 40 cents. Most of all, this is based on around the clock trading. So it opens from Monday 7 a.m. Singapore time to Saturday 6 a.m. Singapore time, 24 hours trading. You can also trade at night during US trading hours, which is when the market movement is more volatile. We also have an app for you download in the App Store or Google Store for trading, so you can trade on the move or at night on your PC after work. But the weekends are closed because the exchange is closed during the weekends. Okay, we have actually covered the first description of the contract specifications of COMEX Gold Futures. Hope you're following. If not, you can post your questions and I'll answer them at the end of the webinar. Over here, we'll move on to the calculations on COMEX Gold trades, right? To keep it simple, I'll use a micro gold contract of February here. As you can see, the price for that is bid price at 1835.6 versus the ask price of 1835.7. You'll be able to make a purchase at the market price at 1835.7 with this illustration. So looking at the contract size of 10 ounces over here, right? The initial margin requires 1,100 US dollars, which is 17 times leverage, right? The smallest tick movement is 0.1, right? It's equals to 1 US dollar, right? With this in mind, we can actually go on to calculate each trade that we do. You can, as mentioned, is a bi-direction market, but in this example, we will do the buy trade. To buy COMEX Gold or long gold, it means the same thing. But let's buy one lot of COMEX Gold, the micro contract size at 1835.7 market price, and then the market rises to 1840.7. Right? At this price, we sell it back to the market, and we make a profit of $5 in the price of gold per ounce. Right? Over here, as you can see, one smaller stick is 0.1 equals to 1 US dollars. This movement of 5 in the price of gold is actually equals to 50 ticks. Right? So 50 ticks. So it's 50 times 1 gives you 50 US dollars in profit. So in this trade transaction over here, you have actually made a profit for $50 by trading in one micro lot size. And this movement is quite reasonable for retail investors that's beginning to trade in COMEX Gold. So the round trip commission, as mentioned, is about $3.40 coming in February. So account balance, you have to consider that as a P&L. So having known that our funds in account is 1,100 plus 50, which is a profit that we have realized, minus $3 of commission roughly, is 1,147 US dollars in the account that will be credited directly in the account. So that's the flow for the buy trade. That's a profitable trade. I think it's quite straightforward, right? This is considered an intraday trade. So typically, sometimes you might hold a position overnight. So that's what will come on the next slide. Over here, using the same example at the same price, we are looking at the micro lot size again, and initial margin is once again this value, and smallest tick is 0.1 equals to 1 US dollars. However, the difference this time is with extra funds in the account. Instead of just $1,100, we put in excess funds, so we have $2,000 in the account, more than enough to start one contract, but slightly not enough to do two contracts of micro gold sizes, right? So over here we buy gold again at the same price at 1835.7. This time we did not exit the position. We let it roll past 6 a.m. Singapore time, and the exchange releases a settlement price, and it is given at 1845.7, right? As you can see here, doing a simple math calculation, that's an increase of $10 in the price of gold. So one tick is 0.1, $10 divided by 0.1, you get 100 ticks movement, and 100 times 1 gives you 100 US dollars. But this is considered the unrealized profit because it's based on the settlement price and subject to fluctuations of the market price, which you see that's ongoing constantly. So therefore, your account balance or in your statement, you'll see the next day, $2,000 in the account which you already have as your account equity plus 100 unrealized profit give you 2,100 US dollars, right? So this is actually the unrealized profit, and it will be prone to changes until you exit the price at the selling price of the market at the point of time, right? So this is again a profitable trade, but you hold the trade overnight and mark to market the settlement price. In this example, because it's a positive increase that's in your favor, you will not have to do anything to top up, right? Let's look at the example where a margin call is triggered, where the position, the market goes against your position. So this is actually the same example again to make it simple. And this time we have the funds in the account at 2,000 US dollars, right? So to buy the gold at 1835.7 again, but this time at the end of the day, the price did not rise. It drops down to 1735.7, right? A big drop of $100 in the price of gold. Well, that's not really possible on typical days, but on a black swan event, it's possible, right? If there's a huge volatility that happens maybe once in every 4 years or 3 years. But in order to trigger the margin call, I'm using this extreme example of $100 drop in the price of gold. So that gives you a 1,000 tick drop in the movement, which is a 1,000 US dollars loss that is unrealized. Well, unrealized meaning that if it comes back in your favor again, you can reduce this loss or maybe even turn profitable. But at this point in time, you can see your account balance $2,000 USD minus 1,000 unrealized loss. Your balance remaining account is 1,000 USD. All right. But having known that we have to maintain the initial margin $1,100 every single day. So this is actually dip below that amount already, and we need to top up to maintain this position. So the margin call amount will be calculated as follows, right? So it's 1,100 minus 1,000, which is the funds you have in the account. There's a shortfall of 100 US dollars that you need to do a top up. And you have to do this top up by 2 working days, right? If not, at the end of the second working day, the position will be liquidated and you'll realize your loss of $1,000 USD or whatever market price at the point in time that is triggered. So if it turns positive on the second day, this margin call can be reversed and you do not need to do the top up. But typically, we will advise you to put in substantial excess funds to maintain your position so as not to be disappointed when the position is being liquidated. Yeah. So this is the example for the margin call. Yeah. No worries. Maybe this is your first time listening. You can come back to this slide again and go through again the calculation for the margin call. All right. Okay, good. We have finished the first part of the webinar. On the next part, we'll be doing the fundamentals analysis. Just take a 10-second break. Okay, so for the fundamentals, right, the first important fundamental that's affecting the price of gold will be the gold supply and demand. So the US Federal Reserve tops the list of the central bank gold buyers. The US holds about 8,134 tons of the yellow metal, almost doubling second place, Germany's number of 3,364 tons currently. Italy, France, Russia takes the third, fourth, and fifth spots respectively. China and Switzerland holds the 6th and 7th positions. So a quick mention that Russia has spent more than 40 billion building a war chest of gold over the past 5 years, making it the world's biggest buyer. This is part of a broader strategy outlined by President Vladimir Putin to de-dollarize the Russian economy and lower its vulnerability to US sanctions and deteriorating relations with Washington. Gold is now the second biggest component of this central bank's reserves after the euro dollar. Gold is a well-known safe haven investment, prone to acting positively in times of uncertainty and market volatility. It is viewed as an asset that holds no liability, adding to its ability to mitigate risk. Hedging against the effects of inflation is another reason why central banks buy gold. In order for inflation to not dramatically impact a country's economy, the nation requires investment that's not tied to the US dollar. So the total gold held by institutions, which is by ETFs, rose 0.6% this year to 107.4 million ounces, the highest level since November 30th last year. The State Street's SPDR Gold Trust, the biggest precious metals ETF, maintained its holdings at a total of 38 million ounces and has a market value of about 70.5 billion. So they are still maintaining its holdings of gold. Support is likely to come also from pent-up jewelry demand, typically during festive season. So after the pandemic phase, we will see countries like India and China, right? There will be a recovery in the gold demand. Next, we also look at the global mine supply, which is rising 10% year on year to around 3,350 tons in 2021, after the lockdowns and the closure of mines during the second quarter of 2020. So in conclusion, on the supply and demand side, global banks have been net buyers of gold since 2010, and this has been a trend all along. And that is the point that there will be still demand a high price of gold as central banks and institutions continue to be the biggest buyers and supporting the purchase of gold. Okay, next we will look at the FOMC, which stands for the Federal Open Market Committee statement given by them, right? The FOMC may significantly affect the gold market as it sets the interest rates as well as other parameters of monetary policies. Gold is a non-yielding bearing asset, meaning it does not produce any form of return unlike corporations. So it's sensitive to other factors such as interest rates. The unit metal serves as a safe haven asset, so it reacts to signals sent by FOMC members, the chairman, and his members about the condition of US economy. That is why gold prices often move after the FOMC monetary policy statement is issued or the minutes of the meetings is released. When the FOMC is more dovish than expected, the price of gold often rises as it implies a slower pace of tightening and lower real interest rates. On the contrary, when the FOMC is more hawkish, which means it's more bullish than expected, gold prices often decline, as it suggests a more aggressive normalization of the monetary policy and higher real interest rates will pursue. In the last FOMC statement on the 16th of December 2020, the Federal Reserve is committed to using its full range of tools to support the US economy in this challenging time, thereby promoting its maximum employment and price stability goals. Few of the main takeaways from this is that the committee will aim to achieve the inflation rate moderately to about 2% by keeping the target range of its federal funds rate at 0% to 0.25%, so maintaining low interest rate environment, right? In addition, the Federal Reserve will continue to increase its holdings of the Treasury securities by at least 80 billion per month and of agency mortgage-backed securities by at least 40 billion per month until substantial further progress has been made towards the committee's maximum employment and price stability goals. In other words, continue printing money and buying more Fed Reserve Treasury bills, and until the economy recovers, they will slowly taper back on this, right? So this is the situation, fundamental situation right now, a low interest rate environment, together with a purchase of the Federal Reserve bills. Of course, this has happened several times in the past. This is not the first time they do this. The last time Fed announced was on April 9th. The Federal Reserve announced that it will inject another 2.3 trillion to prop up the American economy through a series of unprecedented emergency initiatives that will extend its reach to small and mid-sized businesses, as well as state and municipal governments. So as you can see at the top, when they announced that the gold price actually increased during the mid of last year, tremendous. That's where we see the testing of the $2,000 price of gold and beyond. So our country's highest priority must be to address this public health crisis, providing care for the ill and limiting the further spread of the virus, the Fed Reserve Board Chairman Jerome Powell said in a statement. He said that the Fed's role is to provide as much relief and stability as we can during this period of constrained economic activity. And our actions today will help ensure that eventual recovery is as vigorous as possible. So later on, a statement from Powell last Thursday said this, quote, "Now is not the time to be talking about exit from the 120 billion in government securities that the Fed is buying each month. Ill-timed Fed talk of trimming bond purchases after the 2007 to 2009 financial crisis at one point triggered rapid changes in global bond yields and gold prices, a tantrum Fed official don't want to repeat. In fact, during those times, they thought the economy was recovering. I think Ben Bernanke was the chairman at that time. He started to taper back a little, and it backfired, and they had to reverse and start purchasing again. So that's why the point is trying to be conveyed over here. Fed Chair Powell is actually committed to providing this purchasing until that confident that the COVID situation is over and the economy is finally picking up. So this is because recent rumors of tapering back on stimulus resulted in low gold prices. So people are speculating that they are trying to taper back that everything is coming back to normal. So this has now been denied by the Fed chief himself. However, on the condition if the COVID-19 vaccination is carried out successfully and the economy gets back on track, Fed will be tapering back the asset purchases at some point in the future, but that will probably not be happening anytime soon until at least in the second half of the year. And it will be illustrated by a slow process and not a decisive one-time cut to zero, right? So we are still a long way from that, and we still expect if the thing turns further south, any further announcements of printing more money or more government security debt purchases for higher amounts, right, will result in the further weakening of the dollar, and we will see gold prices probably push to 2000 if that happens. If not, at this point, they are just maintaining the purchases. I think gold fundamentally should be within the range that it's doing right now at this moment. Right, the next fundamental we look at is the Biden's administration. Biden has been inaugurated today, but he has a stimulus relief package plan, the 1.9 trillion pandemic relief package, which will be implemented that focus on three main aspects: COVID, relief, and infrastructure. Billed as the American Rescue Plan, Biden wants to spend $350 billion to state, local, and territorial governments to keep their frontline workers employed, distribute the vaccine, increase the testing, reopen schools, and maintain vital services. The plan also calls for sending another $1,400 per person to eligible recipients. This money will be in addition to the $600 payments that were approved by Congress in December and sent out earlier this month for a total of $2,000. Congress opposition is expected, causing gold prices to drop at the end of last week. So, but right now, after it's inaugurated, we see a rise in gold prices again. So this is just doubts on the package being passed through. So if the package does not come through in the full figure, there may be if the package does come through in the full figure as proposed, there will be a short-term rebound in the gold prices, right? Another reason for the dip in gold prices that we see last week was due to the rise of bond yields. This is another thing that's followed closely. This means that with higher bond yields, the treasury bills will seem more attractive than gold, and therefore more purchases and flow of funds will go into the treasury bills. But it's deemed as hard to sustain because the Fed, as mentioned, decides not to increase rates anytime soon. In the past, the Fed's transition to reduce government debt securities is a very slow and calculated process. They will start to also buy longer dated ones, meaning instead of the 10-year bills, they'll buy the 30-year bills. The slow transition over, which could be the first signs that of transition into economic recovery, and also the possibility of return of higher interest rates. All these are not seen at the present moment. So until that happens, I think the situation for gold price is going to be maintained and not going to depreciate any further. So in summary, for the fundamentals, we have looked at firstly, central bank buying as the main bias, followed by institution buying, which is activated by ETFs, the SBTR Gold Trust, the fund managers, right? And also seasonal buying, which is not in discussion much today due to the pandemic, but typically during festive season, China and India are also buying seasonally for gold, right? So these are the three most important buyers of gold. There has been massive gold stockpiling in 2020 from central banks, and ETFs has maintained its holdings as well in 2020. In the beginning of 2021, this year, institution buying has dipped a little in the start of 2021, something to take note. Next, the FOMC rate decisions influence gold prices. So this is due to the fact that gold prices are inversely related to the US dollars. An ongoing weakening dollar will be an impetus for higher gold prices. The reverse of this policy is currently nowhere in sight, but a guess would be the last quarter of this year if the economy recovers quickly enough. Next, the doubts casted on fiscal policies implemented by Biden's administration to fully push through, but Biden is actually in control of the Senate and House. This means that although as much as there's opposition, it will ultimately push through since he has a number of votes to push any policy he wants to, right? So that's going to be just provide more momentary short-term volatility in the price of gold, but overall it will still be maintained and supported, right? Lastly, the bond yields rising. That is a problem which Fed is following very closely, which is linked to inflation and so forth. So as mentioned, the Fed Chair Powell has verbally intervened. This is one of the tools he will use his voice to sound out what the Fed will threaten to do, not say threaten, but would actually do if things go south, giving reassurance to the market that support will come and more money printing will be available if things go bad. So there are still tools in Fed's arsenals, definitely, and they will certainly take action besides giving verbal comments in the future if the yields go out of control. So all these are actually good signs that it's still much in control at this point in time, right? The structural drivers that drive gold price to historic highs the last year to 2000 remain unchanged in the bigger picture. Big corrections of prices due to short-term fluctuations are viewed as buying opportunities. Our market view remains bullish for the long term as the US dollar is expected to remain structurally weak in the long term. Unless Fed reverses its policy, the key drivers of gold, that's real interest rates and the dollar, are expected to remain soft without concrete economic progress worldwide or until an effective vaccine becomes widely available to the masses. Right, so that gives the summary for the fundamentals. Now let's take a look at the technical perspectives of gold. Shown here is the daily chart of gold. It's good to take a step back and have a look at what gold is doing in the bigger picture. We can see gold has risen substantially since 2019 and tested the psychological level of $2,000 an ounce. The highest price reach was about 2063. After that, gold prices have corrected itself for about 61.8% Fibonacci retracement from the wave up for the price from 1,665 as shown in the chart. So there is main support at about 1,791. Hence, the big range for gold will be 1,791 to 2,063, as indicated by the two bold red lines shown in the chart. This will be the big range that gold will be in for this moment and this few months, I would think. Right about in the middle is the intermediary resistance shown by the thin red line. This is indicated at 1,950. Currently, gold is in a consolidation scenario. Big swings are seen at the moment from 1,950. As you see, every time it goes up to 1,950, a big sell of buyers, influx of sellers comes in at 1,950. With a big momentum swing selling at 1,950, it's expected this will continue for a couple more times. So only when the price momentum subsides, we will see the prices to leave the range of the intermediate range of 1,791 to 1,950, which means shorter body candlesticks, not so long ones, as you see currently long red candlesticks, will start to appear, so shorter ones. The direction it takes will then be decided later in accordance with how the fundamentals transpire, the fundamentals factors that we discussed earlier, whether more printing of Fed money, more fiscal stimulus is made into the market, right? Will decide the direction of gold prices. In a consolidation scenario, a buy low, sell high short-term strategy will be used until the momentum fades out and the range tightens. However, it's important to place a stop loss when you're doing range trading, as if the market goes against you and it leaves the range, it will be quite important that you take the stop loss. So to take note of the support at 1,791 if it goes south and you're in buy position, right? But the ultimate stop loss has to be below the 1,765, which is the recent low that it made. Right, so there's a typo here. It's the recent low of 1,762 also. Yeah. So that gives us the big picture on the daily chart of gold. Okay, right now we'll actually move on to the trading platform demo. Having discussed the fundamental technical analysis, on the trading platform, this is the Nova. You can see here the screen is split up into three portions, right? This is where the price codes are stated. This is the trade menu or the chart if you wish to change it, and this is the working orders which you monitor, right? So after you adding contracts, you can see COMEX Gold here. This is the regular contract size of February 2021. Currently it's at this price. US market is not yet, right? It's about 10 cents or 20 cents spread because it's quite quiet right now. Rather stable, which is a good sign. The COMEX E micro contract, the 10 ounces one, is shown here for February contract. So these two contracts are expiring soon. The long positions is expiring the last trading day of this month, last business day of this month rather, and we will inform you when that happens. But what happens is you need to close out the February month and trade the April month if that happens, right? So to start off to trade, you can just click on the name itself and place order. This will bring up this menu over here. So I'll close one of them. This is the micro gold contract of February, as indicated by the tab's name over here. You can see the price is shown, right? You can queue for the price you want. Let's say if you want to buy a price, you typically choose the limit order for entry or position. That means to queue for the price you want. So you can queue for a lower price. Let's say you want to set it at 1,850, just for example, right? And then you can proceed to click on the buy button, right? On the other side, as this is a bi-directional market, you can also sell first and buy back later. No problem if you think the market is coming down. For example, you can queue for a higher price. The price is actually 1,871. You can go for 1,900 to sell and click on sell button to queue for this price. I won't click because this is actually a live account for me. So that's how you place the order. So once you've done that, you will come into the working orders tab over here, right? This is another contract, but basically the columns are the same. It's a working order. You will see the limit price queuing at how many contract lot sizes at what price, right? And it's until good to cancel, right? GTC order or good for the day itself, depending how you set it. Yeah, but the order ID is also given, and the account number, of course. Yeah. So that is how you see the working orders, and completed orders are shown over here. Once it's done, it will be shown as filled order. So it's very simple. The flow of orders from the price codes. Clicking on the trade menu, you enter your details, and then working orders to be monitored and completed orders to be confirmed over here, and open positions to be shown over here, right? So after you have the position, to take profit is the same way. You can queue for the price you want using the limit order. The other order type you can take a look at is the stop loss order, which is important to prevent big losses, right? You need to protect yourself and you're away from the computer or overnight, but typically intraday trades would be the safe way to do so if you can. But sometimes get caught on the wrong side or the market doesn't move yet. You want to protect yourself, you have to instill a stop loss order first. So that will be a stop limit order, and for this you select the stop price. This is not an OCO order, this is just the stop loss price. So the trigger price, for example, let's say if you're positioned to buy at 1,870 and the market goes against you and reaches 1,800, which is very low, the trigger price, the ultimate stop loss you want to put at 1,800, you can do so. And then from there you can put the range where you want to take the stop loss. So from 1,800 to 1,795, for example, and it will try to work the price until it's triggered. Meaning, say you are willing to take the stop loss or sell stop for that position of a buy position you have if the prices dip below 1,800 until it's triggered. Yeah, so this is how you place a stop loss order. Right, no worries if you have any problems right now. We can have one-to-one coaching session to answer any questions you have and go through the process again with you. So next, I would like to show you also the chart itself. So from here, by clicking on the name, you can actually look at the chart. Yep. And then I just close off the other chart. I think so. Okay. So I will use the COMEX Gold February chart again, right? So over here to maximize the chart, you can click on this button icon over here, and over here you can see the February gold prices chart. This is the daily chart, right? We have a smaller time frame also for the 1 hourly chart. So over here, as you can see on a smaller time, after looking at the big time frame previously on the slides, you can actually go into the 1 hour time frame using a dual time frame approach to see opportunities of entry levels. So over here, I can see clearly there's a range over here, right? I'll box this up later for you. And then this is where we are about to enter this range as well. And we are leaving this range over here. So I'll just draw the line to show you what I mean. I think it's this one. Yep, geometric drawings, horizontal lines, support lines. So I will draw on this support over here for you to see. So currently you can see that there's a support over here. This is the beginning of this big range over here, and define it up to the top of the range, which is over here, I would say. Yeah, roughly about that. So this is the range that the gold prices will remain in. So this is actually 1,864 to 1,903. That's likely to. What we see here is gold has actually left this region over here, right? As you can see, a strong movement passed out, and it tested from the other side this support level. So mainly it's more or less decides to stay supported above 1,864, and actually it's seen as a good buying opportunity. You can put your stop loss tight over here if you want, and then go for the profit on the top side. So on 1 hour time frame, that is my advice at this moment. But this is just putting a disclaimer here that what I see is that the range will be trading over here from within this range, and likely you will continue to trade. As you can see, a lot of movement previously, there was a lot of buyers and sellers movement. So in the middle, they will be going for around here. I'll draw in the line again. Midline between this intermediary range will be this price level over here, right? So roughly about 1,880 will be where it's heading at first, right? So the consolidation phase in the big picture. So, but right now the range of the prices would be 1,864 to 1,903, right? So this is actually there's a lot of other indicators available. You can choose if you prefer to use indicators. You can select any of these indicators over here. So due to time constraints, I'll just touch on this for now. You can also ask for a demo of this Nova platform. I'll show you the QR code later for you to scan and try it out. However, you'll not be able to see COMEX Gold. You can see SGX Singapore contract to practice, right? Because the live price access for CME US exchanges actually being exalted and is not available on demo. But the overall platform layout and everything, you can use that to traverse a bit and have a feel of the platform, right? Okay, we have covered the platform demonstration. We are almost coming to the end of the webinar. I hope you have found some information useful. Let me just touch on the available services offered by Phillip Capital. If you sign up for the account with me as your servicing AE, which is available online using the QR code, which I'll show you later, I'll be providing the WhatsApp economic data updates every week. There will also be technical discussions on the trades, and I'll be assisting you with any questions pertaining to your account or your trading. Free one-to-one coaching can be pre-arranged either via Zoom or face-to-face if you open an account with me. On top of that, right, we have our in-house analyst which emails technical reports on suggested levels for your reference. This will assist you in making decisions on entering at the better levels. The daily commentaries for fundamentals, we also have commentary reports to give you updates on the economic news that's happening around the world. This will keep you abreast on the latest economic news that might have potential impact on the markets, saving you the work of searching for it on the internet. So as you can see here is the recent gold daily report sent out by our in-house analyst on the gold prices. Hence, we provide both the fundamental and the technical aspect of trading information to you, and you can have a platform ready to enter the market whenever you are ready. Opening of a trading account is free of charge, so you can have it up and ready, and when you wish to place any trade, you can just fund the account and it will be credited within 45 minutes, and you can start trading. So with that, let's see if we have any questions. Anyone posted any questions so far? Okay, the first question I see here is what is the minimum deposit to open an account? Is there a maintenance fee required? There's no minimum deposit required to open an account. It takes mainly about a couple of minutes using SingPass. There's no maintenance fee also. You can just open the account, account number will be created, and you can just fund the account via PayNow or any of the bill payment functions, and it will be automatically pick up when you indicate your account number, and you can start trading with that. So it's advisable, since there's nothing to lose. You can just get your account started first, and have a feel at the platform, look at the prices, and when there's an opportunity, you can get started on this. This is a good time to start because of the promotional rate of the COMEX Gold. It usually is much higher, at $3, it's 150. So a lot of retail investors are actually coming in to use this instead of gold ETFs, which is much slower, or physical gold. And this is more timely update of the live prices. So the margin required for trading micro gold is actually 1,100 US dollars. So to start trading, you have to fund this amount for one micro gold, 1,100 USD, or if you want to fund in Sing dollars, you can do so. That would be maybe 1,500, maybe, yeah, around that for Sing dollars, or 1,006. And with Sing dollars, you can choose to convert to US dollars or not. It's up to you. But if you do not want to, you can start the position, no problem. But for overnight position past 6 a.m. Singapore time, interest charges will start to roll in, and you have to pay interest charge at 4.5% in for the US dollars, which is a small amount considering 1,100 for a few days. It's not that bad. So I would suggest if you want to maintain long-term position, you will have to convert to US dollars. But since USD is weakening, it's not advisable for short-term positions to convert to USD. Any frequent indicators used to track the movement? Right, this is actually a technical question analysis. There's various indicators out there. The one I mentioned to you right at the start is the support resistance lines, a big picture, which is actually the most important. You will not like to get caught on the wrong side of the movement. In view of the indicators that you propose, it can be helpful, but it's not the most decisive. I would say you can use certain momentum indicators to decide the movement of the prices. But the best one I see useful, it would be price momentum based on the candlesticks. So this can be explained to you further during my one-to-one coaching session. So on how to view the candlesticks, as it takes a bit of experience. Things like you would think that the doji stars and everything and hammer or such indication. Yes, to a certain extent, that will give you an indication of price momentum. But in respect to the positions, is also to the other candlesticks beside it, and how the movement of the market is to decide on whether the price momentum is strong or not. So as you can see, for example, this price momentum selling at 1,950 is very strong. That's where we see that it's hard to push through that price at the current moment until the momentum dies out and shorter bodies start to emerge. The chance of it pushing through is pretty low right now. However, if there's any announcements given by Fed or Biden that's unexpected, right, that will push through the prices, right? So technical analysis can be useful, but fundamentals actually determine whether the prices will push through eventually. Can I trade COMEX Gold options? We do not have that. Basically, we only have index futures options at the moment. So I would not recommend gold options will be quite risky, because gold futures itself is already a leverage product. Options on that would be even a double leverage, so to speak. So I would say gold futures itself is already a big exposure, right? You have to get used to the price of gold first, using that before you consider. Anyway, we don't provide the options on gold at this at Phillip Futures. Do you have any further questions regarding the gold trading or the platform? Maybe I take one more. Can Nova trade Forex? We do have a OTC at Nova, but I would suggest that you use, because for that is the regular contract size of 100,000. I would strongly suggest you to choose the MT5. There's many reasons for that. MT5, MetaTrader 5, is where we trade Forex as well as other OTC products such as CFDs, right? And indices CFDs also, and American shares CFDs. So That platform is very robust already, and there's zero commission. That's one attractive thing about the MP5. Also, the charts and everything is also well built in already. So I would suggest you use the MP5 as the platform for trading for Forex, since that one can go down to micro lot size of 1,000 contract size instead of the regular contract size that's not available on Nova. Yeah, so I will refer you to MT5. If you're interested, just feel free to drop me a message or email, which I'll show you later. Okay. Let's see if we have any further questions. If not, the opening account is free. So on the right here, you can see, and it will be done within minutes. You can open the account using the link shown on the right here. Can you use this link or scan the QR code if you wish to have me as your servicing broker? If you require a demo first, you can scan the QR code on the very left. If you have further questions, feel free to contact me. I will provide the email in the next slide. Right. My email is shown here, wei@phillip.com. Alternatively, you can also drop me a message. Well, that's all the time we have for today. Thank you so much for being such a wonderful audience for tonight's webinar. A link to the recording of this webinar will be made available tomorrow in our follow-up email. With that, this is Phil Gunn. Thank you and have a good evening ahead.